Hello, everybody. Welcome to the show today. Today, we're going to be diving into 7 pitfalls to avoid when choosing both a business entity and the name of your business, which can cost you loans, credibility, and customers. We get so many questions about this topic because the name you choose, the entity you choose, will determine a lot of things that tie into your ability to get loans, credit lines, and business credit. We're going to decode all that today. So for those of you that don't know me, my name is Ty Crandall. I'm actually the CEO here at CreditSuite. If we can ever help you along the way of getting your business set up, building business credit, getting loans, credit lines, basically accessing capital or money to grow, feel free to reach out to us. Our number is 877-600-2487. That's 877-600-2487. And our email is info@creditsuite.com. That's info@creditsuite.com. And if you're watching this on video, you're going to see here, I have a link at the bottom, creditsuite.com/EIN. Here we have a great free guide that will teach you the exact steps to build business credit. And that's creditsuite.com/EIN. You will see that on many of my slides as we progress through today. So why won't any name and entity do? Why can't that work for you? Well, your business and entity matter more than you may think they do. And it really has a lot to do with your ability to access money, your ability to access loans and credit lines. And so many people make mistakes early on in their business, setting it up the wrong way. And that's the reason they get denied. They don't know why they get denied credit and loans, and it has to do back with these things. So what you're doing now and in the future, your ability to access money are both affected by the name you choose and the entity you choose. So you want to keep more of your own money, right? You want to keep more of your profits and make more money and get more money through lenders. Well, that's exactly why we're talking about this today. So let's talk about entities to start with. Well, the IRS recognizes these entities as entities for businesses. Sole proprietorship, partnership, and corporation, basically. Corporation can be broke down into two, a C corporation and an S corporation. Now, an LLC is not really considered a separate entity by the IRS. Now, you should know that. You can still choose an LLC, as we're talking about here, and we'll progress today. But from the IRS designation, they're looking at a sole proprietorship, partnership, or S or C corporation as an actual individual entity. So one of the first pitfalls that a lot of people make is that they're not choosing the right entity that basically makes it where they have to pay more taxes than they need to. None of us want to pay more taxes, so this is important, especially this time of year. So sole proprietors are the same as their owners. The owner pays taxes on the sole proprietorship's profit. So let's dive into this. The one thing to know about a sole proprietor is that when you are a sole proprietor in entity, you are the business. You and the business are one and the same. So the business's taxes are also your taxes, which means if the business makes $100,000 in profit this year, that profit carries directly over to your personal taxes, and you're paying personal taxes on the $100,000 in profit, for example. Now, a partnership does not have to pay the income tax. Instead, the business will pass through its profit or losses straight to the partners. Okay, then the partners will include their respective share of the partner's income or loss on their personal tax return. So partnership, exactly the same as a sole proprietor, but the difference is there's more than one person, right? There's partnership, there's more than one person. There's at least 2 people to be partners. So it's the same thing. When you're a partnership or a sole proprietorship, you and the business are one and the same, which means that when you actually pay taxes, if the partnership makes $100,000 in profit, that carries down and is divided per whatever the partnership agreement is onto the individual's tax return. So for example, if you and somebody else go into a partnership together and there's $100,000 in profit and you have equal ownership and the partnership agreement says you're equal owners, then that means 50% or 50 of that $100,000 would go to your personal tax returns, 50 of the $100,000 would go to your partner's tax returns as well. Now with a corporation, well, the business itself, the corporation pays state and federal taxes. And they sometimes also pay local taxes in some areas as well. So this will include paying income taxes on profits. Okay, so what happens with a corporation is the corporation itself, you're paying taxes on the profit, not like a partnership or sole proprietorship where you as an individual are paying the taxes. With this kind of entity, the business, the corporation, the C corporation, for example, can end up paying taxes. Okay, so what happens is basically you could end up paying taxes 2 times here with a corporation. First, you pay taxes on the profit, whatever's left over in profit at the end of the year, the business is paying taxes on that. And then when it actually gets split up, when the corporation pays dividends to the shareholders, pays money out to the shareholders, that can be taxed as well. So something to think about. The corporation, you and the business are separate, but you can also pay more taxes this way. Now, an S corporation, only the wages of any S corporation shareholder who is also an employer are subject to employment tax. Any remaining income is payment to the owner as a distribution. So the way an S corporation works is basically the profits carry over to you as a distribution on your personal tax return, and you're paying taxes much the same. So if you don't want the business to pay taxes and then you personally to pay taxes, well, then you might choose an S corporation. Because with an S corporation, what happens is the profit of the business can be passed down again to you as the individual business owner, and then that makes it where you're just paying taxes on those distributions, not paying taxes twice. Now, an LLC is not a separate entity according to the IRS, so it isn't taxed, but instead the members pay individual taxes. So members of an LLC pay an employment tax on the entire net income of the business. So you're basically just paying taxes on all the profit or the net income of the actual business itself. So it works very, very, very similar to what you're going to see with a corporation, even though it's not considered a separate entity. So what's best here? When we look at entities and taxes, it kind of works like this. You probably want to stay away from a sole proprietorship or partnership. You are the business then, which creates multiple issues, as we'll talk about, but one of which is the fact that all the profit of the business is going to roll to your personal taxes. So as you get bigger, the problem is that's not going to make sense. If you're a small business as a startup, that could make sense short term. But long term, you're probably going to have to change your entity state anyways, because you don't want a business making millions of dollars and the profits carrying over to your personal tax returns. If we look at a corporation or an LLC, they do make more sense. With a corporation, there's 2 choices, an S Corp or a C Corp. With a C Corporation, the business pays its own taxes. Then you get distributions or money from the profit gets put to you, and then you pay personal taxes. So as you get bigger, this makes sense. But as you're smaller, you probably don't want to choose a C corporation for tax purposes. Why? Because you're paying taxes twice. The business pays taxes on its profits. Then the problem is that you're also going to be paying taxes as an individual as well. So you're paying taxes twice, which again, may make sense for you as you have a bigger business. But again, as you have a smaller business, it doesn't make as much sense. This is why a smaller business, you're going to probably go with an S corporation. So if you're choosing a corporation, you probably want to choose an S corporation as a smaller business, because then the profits go right to your tax return and you're okay with that. But the problem is that as you grow bigger, you could just switch from an S corp to a C corp. So just some considerations here when it comes to business entities and taxes. Of course, it always makes sense to actually talk to an accountant about these things as well. So pitfall number 2, legal liability. Well, sole proprietorship, there are no limits to personal liability. If the sole proprietorship did it, then so did the business owner. Okay, that's what it looks like. So what I'm saying by this is, let's say that something happens and the business gets sued. Well, as a sole proprietor, you are the business. So if the business gets sued, you get sued. So if the business did something, well, then you did it too, and you get sued. This also includes debts and obligations and any risks of action of employees. Anything that can get you sued could also mean that you're personally liable. Again, not an attorney, not an accountant. So I'm talking about somewhat maybe legal advisor, so I have to disclose that. But that is how a sole proprietorship works. You and the business are one and the same. So the problem with this is that with the sole proprietorship, then what happens is you are the business. And then at that point, if the business gets sued, you get sued. If the business defaults on any obligations such as business credit, even if you didn't provide a personal guarantee, they could still sue you because you are the business. Now, partnerships, well, partners retain full shared liability as well. So the partners are also going to be liable for their actions, the business's action. They're liable for any business debt, decisions made by the partner, anything that you may default on, any lawsuits, etc. So because of that, it's much the same as sole proprietorship. It's just you have more than one owner. There's more than one people. That's why there's partners. But again, if the business gets sued, the partners get sued. If the business defaults on its debts, then you are defaulting on the debts and can be sued for that as well. Now, with a corporation, the shareholders' personal assets are protected. Shareholders can usually just be held accountable for their investment in the stock of the company. However, if an employee commits fraud or a felony under the corporation's direction, well, then the corporate veil can be pierced, per se, and personal assets can be on the line. So obvious remedy, don't tell your employees to commit fraud or felony. So we look at this as a corporation, you and the business are separate. So if the business gets sued, well, then in that case, you're separate. You can't be personally sued. Or if the business actually defaults on its obligations, then the business can be sued, but you can't. And the exception to this rule is if somebody under the corporation's direction commits fraud or a felony, well, then you actually can be. Then the corporate veil could be pierced, and then they can come after you personally as the owner of the corporation. But as long as somebody's not committing felonies and fraud, well, then you have a much deeper layer of protection than you would have if you were an actual sole proprietorship or partnership. Now, an S corporation, shareholders' personal assets like personal bank accounts cannot be seized for the purpose of satisfying any business liability. So again, your personal assets as an S corporation can't be pursued. So if you default on business obligations, the company gets sued, you have a layer of protection there. Now, LLC members are protected also for personal liability for business decisions or actions of the LLC. The LLC incurs debt or is sued instead. The members' personal assets are almost always exempt. Okay, but not always, because there is limited liability. Again, if you're committing fraud, if there's a felonies taking place under your watch, you can't just say, well, I had nothing to do with this. We've seen this before, right? We've seen some huge companies, I think Enron for one, actually the owners, the people that are the actual main people that own the actual business are getting sued as well because there's all kinds of rampant fraud and felonies that are taking place. So you can't, and they do this because you can't just hide behind a corporation to go commit all kinds of crimes and not suffer any liability. If you're doing that, you could suffer liability. But outside of that main exception, corporations and LLCs give you a layer of protection. If somebody sues the business, they're suing the business and not you. It separates your personal liability. It gives you a layer of protection. So as we look at Pitfall 1 and 2, so far corporation and LLCs seem to be the best. They're the best for tax purposes. They're also the best when it comes to separating this legal liability. Now, when we talk about Pitfall 3, we talk about cost and share. So a sole proprietorship, the owner is the company, as we talked about. So that if it makes money, so does the owner. Their share is 100%. Your share is 100% of the business because you're a sole proprietorship. Now, partnership shares vary. It's based on a partnership agreement. So they're split equally if it's not disclosed, but most partnerships have partnership agreements, and the partnership agreement might say that you and I are partners, that you get 75% and I get 30% ownership. But that's actually determined in a partnership agreement. If not, basically shares or ownership shares are split equally amongst the partner. Now, an S corporation is another type of corporation, and the only real difference is liability rather than share and cost. So it really works the same as other kinds of corporations, which we'll talk about now. So a corporation is basically run by a board of directors, usually the owners of the corporation. Okay, ownership stakes are defined by what percentage of stock everyone's owns. So if the person's controlling interest has over 50% or 100%, then their decisions will generally overrule everyone else. That's how a corporation works. So you're appointing shareholders, and the shareholders, you determine how much each one has stock. So for example, if I have a team member on my team that's extremely valuable, I've also promoted to an executive management position, I can elect to give them a percentage of my shares. So maybe I don't own now 100% of the corporation. Now maybe I've given them 20%, and now they have 20% stake or stock in the business, and I have the other 80%. So profits are generally distributed per share percentages, although the board members can take a salary. So the owners of the business. So let's say I own the business, and I have somebody else. I say, you're killing it for me. I'm going to promote you up to an officer position, a CFO to handle finances, or an operations officer position. And I want to give you 20% shares in the business. Well, the way a corporation typically works is then you'll set up what are called distribution schedules. So maybe I say we are going to do profit distributions twice a year, which means that we look at twice a year and 40%, again, I can determine this percentage. And we're going to say that 40% of what this company makes in profit is going to get distributed to the shareholders. Okay, let's say that's the agreement. Twice a year, 40% of the profits get distributed to the shareholders. Okay, and it's June 1 and January 1, let's say, for example. So what happens is once June 1 would come around, then we would look at the profits that were left in the bank account. We would say, okay, in my example, I have 80% ownership and you have 20. So we're going to take the profits. Let's say there's $100,000 in profit. And let's say the shareholder agreement agrees that 40% of that money actually gets distributed. So we're at 40,000. And let's say I've given somebody else 20% ownership of the business. So 40,000, 20% of that is 8,000. And so then of the 40,000 that gets distributed, I would keep 32,000 and somebody else would keep the 8,000. So how did I come up with that math? Like I said, we've decided in this scenario that there are two shareholders. Me, I own the business. I gave somebody else 20% ownership share. We as the business, we decided to do distributions of profits twice a year. We decided to do 40% of the profits distributed. And when we do the math, every distribution, for example, if it was 40 grand, I would get 32 grand, they would get 8 because they get 20%, I get 80% profit. So that's how it is. So you decide the share percentages people have. You decide when distributions take place. You decide the percentage of distribution that takes place. And then you just split it up based on the percentage of ownership that the individuals actually have that are owners or shareholders of the corporation. So an S corporation, a shareholder working for the company must pay him or herself reasonable compensation. So the shareholder has to get fair market value, or the IRS may reclassify any additional corporate earnings or wages. The bottom line is that as an S corporation, you still have to pay yourself. You still have to have some kind of salary or money you're earning. You can't just claim no money and have the business making all the money and paying all the taxes. It just won't work that way. So pitfall number 4 really relates back to a name for a business. When your business is called Things and Stuff, okay, nobody knows what you do, okay? So that's the purpose, is when you are choosing a name, you do want to have some kind of name to indicate what you do, okay? Could be anything. Without a reasonable expectation of what it is or what you do, then a customer is not going to really know to dive in deeper, right? And here's an example. Enjoy the store is on their banner. Well, if you're walking by, you don't even know what's in here, so your chances of walking into the store with a banner of enjoy the store probably is not going to be good. But if it says, the place for candles, and you happen to be looking for candles, well, you're going to go in because you know exactly what the store is. Or if the company's name is Candles and Things, well, then they obviously sell candles. So it gives you a more specific idea of what they do. Now, plus you're losing an opportunity to market with your company name, because again, if your company name has some kind of indication of what you do, then the name itself becomes a really good descriptor of what the business does. So without somebody even diving in deeper, they have a pretty good idea of what you do. Okay, so for example, our company's name is CREDITSUITE. Well, by that name that we're doing something with credit just based on our name. So again, giving some kind of indication in your name of what you do and not keeping it generic gives your potential customer some kind of idea of exactly what you do. Now, according to Entrepreneur, you can get away with this if yours is the first company in an industry. So as an example of this, if we look at General Motors and International Business Machines or IBM, well, they work pretty well because, again, they are the first ones. They were the first ones in their actual space. But calling your company the store is not going to do anything. So the bottom line is that unless you're the very first early adopter in a space, which are called unicorn companies, which is very rare to do, you're probably going to want to give people some kind of idea what you do. So a lot of friends of mine are in the credit repair business, and one of them that comes to mind is Credit Restore. One of my friends has a business called Credit Restore. Well, you pretty much know what that is. They're restoring credit. That's a pretty smart name because the name itself indicates exactly what you do. So if you have credit issues and you see a company called Credit Restore, you have a pretty good idea that that potential company restores credit. So the name itself gives you a specific idea of what they do. Now, also relating to name, another pitfall to avoid is you don't want to use mashed up names where two different words or distant words are slapped together, or words you kind of put together to make it fit. Okay, so if the name of your company is Cheese Ninja, then do not be surprised if customers still have no idea what your company actually does, right? They get cheese, they know what cheese is, they know what ninja is, but what's a cheese ninja? What do you cut cheese? So of course you could really have problems here when you're trying to combine a couple names that aren't a real good reflection of what you do. Do you sell cheese? Do you make it? You don't really know in this example. And again, what's up with that ninja part? Are you a stealthy cheesemaker with an invisible, daring, undisclosed location? I mean, you know, what does cheese ninja mean? And so when you're putting together words don't necessarily go together well, then that alone can still create more confusion and can turn people off before they even looked into your business, okay? So maybe, again, if you're taking a truncated part of the name is often something like Amera or Tron or Quali or Port. It's a portion of a name instead of an actual full name. So make sure the individual parts actually make sense for your business. Sometimes these elements can work, sometimes not. After all, without Googling, do you know that flipdog.com did? And again, that's a perfect example. Flipdog, what do they do? Well, you have no idea. You have to look them up. Here's the problem. A percentage of your prospective customers, they're not going to want to look it up. And so you're going to lose a percentage of your customers because they don't even know what you do because your name isn't reflective of what you do, okay? They were actually an employment website, and they're now part of Monster. So Flipdog has nothing to do with dogs or flipping. It has to do with employment and hiring. So again, this doesn't usually work in your advantage in the beginning as a startup because your name itself doesn't indicate what you do, which means people have to go searching for more information to figure that out. Now, ugly, bad, deliberate misspellings in your company name can be an issue too, okay? Now, Toys R Us obviously different, right? Toys R Us has the R spelled differently versus the word R. So, you know, there are exceptions, and it nearly always looks bad when you're trying to come up with something like yourself. Now, Toys R Us, well, the concept works because it's a play off child possibly not knowing how to spell, right? That's why they do it. Toys R Us with the R backwards. It's very playful. It works with their model because it's playful, because a child might not know how to spell or write an R correctly. And I can tell you, having two little kids, that my kids are absolutely susceptible to this. They were younger, that they turned many letters around backwards. Anybody that has kids knows and probably has dealt with the same thing. But you're a grown-up, and presumably what you do is grown up as well. So if you thought Cheese Ninja was bad, it looks positively Shakespearean over the train wreck that is Cheese Ninja, meaning you're misspelling the word cheese. And this is so problematic. And I'll give you an example. Our name is CREDITSUITE. Every time I tell somebody that, I have to tell them CREDITSUITE, S-U-I-T-E. Every time I try not to tell somebody that, they say, oh, S-W-E-E-T. So again, you have to be careful because even us, we're not intentionally misspelling our name, but one word sweet can be spelled multiple different ways. So if you're coming in with business with a Z instead of an S, for example, or cheese with a Z instead of an S-E. Well, the problem is every time you say your business name, you have to spell it out. And the problem with that is as you advertise and market on radio and TV, et cetera, as you grow, you're not going to want to spell out the domain every time. So if you're Cheese Ninja, C-H-E-E-Z Ninja, well, then every time you say the name, you're going to have to say C-H-E-E-Z, or everybody's going to go to C-H-E-E-S-E, Cheese Ninja spelled correctly the wrong way. So coming in and deliberately misspelling words is really problematic, okay? The same with coin words. So it can be difficult and expensive to get people to use and know how to spell words like Exxon, Enron, Verizon, Kodak. We're used to this, right? But does Verizon have an S or a Z? You know, does Exxon have one X or two? Does Kodak spell with a K or a C? These were early adopters of what they do, and they spent obviously trillions of dollars advertising, so we know them. But again, I bet there's still a lot of people out there that don't know that Exxon has two X's versus X. So these are problematics when you're coming up with a brand new name that you're just coining and creating. Then again, that can be simple. Now, an exception here is a company like NAV. Nav makes sense because it's 3 letters, which I love. And I mean, you can't really misspell Nav. I mean, just sounding it out, you understand it's an NAV. So there are exceptions if the coined word you're coming up with is really easy to spell and doesn't have the ability for people to misspell. If it does have the ability for people to misspell, get the misspelled words. Buy those domains too. So if you're Exxon, buy EXXON, buy EXON. If you're Verizon and just starting, well, buy VERIZON and VERISON. Okay, people could pronounce it either way. Kodak, buy CODAK, buy CODAC, buy KODAK, KODAC. Get any variation of the word and buy all those domains in case somebody does misspell it. Now, again, names are horrible because we all know them, but they cost the companies money in explaining the rebranding than explaining again to the general public. And they did this throughout many decades. So we now are very familiar, obviously, with these names. But as a startup, you won't get that benefit of the familiarity. So you can get away with this sometimes, but you want to keep it short, at least somewhat relative to your industry. Xerox did this to spectacular results, but became the prefix zero. Means dry, okay? So you got to be careful. That's what Xerox machine could call itself back when the industry standard was mimeographic, which is what it used to be, okay? So again, you know, Xerox, that's a pretty tough. It starts with an X. So as you're a startup trying to do that, everybody's going to want to spell it ZEROX. So again, when we look at companies like Kodak and Xerox, it's unfathomable for us to think about misspelling these because they're cultures of what we do. They've been around for decades or centuries or more. Okay, but when we really look at this, if you're starting up a brand new business, you don't want to choose names that are hard to spell, that have different meanings, that have plays off different spellings, because what you don't yet realize is every time you say that company name and drive a customer where you want them to be, you're going to have to explain it. And all the people that don't hear your explanation will go to the wrong spelled out domain. Now, another big one is that your company name flags as a company being in a high risk industry. This is huge. I mean, if you're looking for money, this is a really, really big problem. And here's where you can go with a generic name. Okay, so, you know, again, this is the trade-off. You know, and I hit this question all the time. Well, do I choose a generic name or not? Well, a generic name will make it easier to get financing versus a name that reflects you're in a high-risk industry, but it won't tell people what you do. So you kind of have to make some decisions, one or the other. If you choose to have something that indicates you're in a high-risk industry in your name, that automatically can get you red flag, denied, or help you face more scrutiny when it comes to automated underwriting decisions like that from credit cards, loans, and credit lines. So there's nothing underhanded about calling your company Chico's instead of Chico's Bail Bonds. But for example, if you call it Chico's Bail Bonds, you're going to have problems because bail bonds is considered a high-risk industry. So the minute you put bail bonds in your name, then the problem there is that it's going to be tougher for you to get merchant accounts, bank accounts, loans, credit lines, business credit, etc. If you put Chico's, well, that's fantastic, but nobody knows what you do. So by just using, so this is kind of the trade-off. It's something to think about. You almost want to choose something that's generic enough, or that is not super generic where somebody doesn't know what you do, but also doesn't reflect you're in a high-risk industry. Okay, so there's nothing wrong with making it short. Just keep in mind, you lose the benefit of telling people what you do in your name. As a matter of fact, you might lose out on loans and other forms of credit because your company identifies you're at high risk. But then again, you may lose customers if it's not specific enough, which is why you got to kind of decide in the middle. So here's some high-risk industries: ammunition or weapons, check cashing, bail bonds, pawn shops, gambling establishment, anybody in financial services, political campaigns, X-rated products, entertainment. So let's talk about this for example. And I can give you some real life examples for myself. So for example, my last company was called Elite Credit. It had the word credit in it. And I can tell you I had all kinds of problems. I had my bank account just shut down just because they didn't like my industry just based on my name. I had a very difficult time getting merchant accounts. Getting financing was very tough as well. Okay. So the next business I started was called Elite Business. Very generic. You know, I do something with businesses because the word business is in it, but you really don't know exactly what I do. And that company dealt with loans and business credit. But I didn't say that because I had such a hard time with Elite Credit that I decided I'd rather have more of a generic name to get specific. Now look at our name, CREDITSUITE. Well, this reflects that we're in financial services. And I can tell you without a doubt, we every day have problems as a result of that. So I'll give you an example. We are trying to get set up to report our customers' payments to Experian. Experian will not approve us to do this because they insist that we are in credit repair. Now, this is crazy because, first of all, we don't even deal with consumers. We don't even deal with consumer credit, and we don't deal at all with credit repair. But we've had two different groups from Experian look at all of our stuff, including our website, and they insist we're in credit repair. It's crazy. If you were to at all look at our site, we don't even mention consumers, consumer credit, credit repair. It clearly reflects that we deal with business credit and loans. But this is the problem with choosing a name that's you're in a high-risk industry. We get scrutinized by banks. It's harder for us to get merchant accounts. It's harder to get loans and credit lines. We have to usually prove ourselves before we get higher loan amounts and line amounts. Okay, we have literally had problems reporting to the reporting agencies. We are constantly being accused of being in an industry we're not. We deal with this with merchant accounts all the time. We have a 10-page synopsis of what we do. We still get turned down by merchant accounts because they insist we're in credit repair, largely driven based on the word that we have credit in our name. So those are some real world examples. So look at your company's name and make sure, and this is kind of a bonus here. I went through 7 already, but I want to jump into a bonus. So don't want to choose a bad URL. Look at what your company's name will look like as a URL. Okay, so make sure it's going to look normal. You will virtually always want to own the .com URL, which your company's name is. So I'll give you an example. When I owned my last company, Elite Credit, or one of my last companies, Elite Credit, I didn't own elitecredit.com. I had like some other, like perfectcredit.com was my domain, which was problematic in itself with that industry. So it was a problem. As we continued to grow, everybody wanted to go search Elite Credit, and they would go to elitecredit.com, even though that wasn't our domain. So we were advertising and marketing somebody else's business ultimately. And you know, when you're starting a business, that's never a problem until it starts to grow. So nowadays, when I'm thinking of a business name, I do it with GoDaddy open. I open up GoDaddy, I think of a bunch of names, I list them, I write them all down. And then what I do is I go search the domains to see if any of them are available. Go to GoDaddy and I say, okay, I want Elite Credit, I want Perfect Credit, I want Elite Business, I want CREDITSUITE, I want all these names. And I try to find a domain or a company name where the URL is available. I can tell you from experience, never do this any other way, because as your company grows, it will be problematic. Okay. You also want to grab the .net, the .us, the .org. There's so many of these now that you can't grab them all. They make sure of that. It used to just be .com, .net, .org. Now there's hundreds of these .tv, .us. But grab the main one. Grab your name.com, your name.net, your name.org. It's very important. And I'll give you an example, a perfect example. We recently had an election where we elected a new president over a year ago. And during that election, Donald Trump actually bought jebbush.com. For some reason, completely unbeknownst to me, don't understand how this could even happen. Jeb Bush was running for president and he didn't even own jebbush.com. Another company owned it. So Donald Trump's campaign went to the other company and rented the domain through the campaign. And if you went to jebbush.com, it would forward right to Donald Trump's website. Pretty smart marketing and exactly the reason on why you want to own your company.com. And by the way, another note, you want to own your name.com as well too. Okay, so just completely out of this subject altogether, it makes a lot of sense right now to go to GoDaddy for 12 bucks and buy yourname.com. As a matter of fact, I own myname.com, my wife's name.com. I own my son and my daughter's name.com as well. I own everybody in my immediate family's names, and I recommend you do the same thing as well, because trust me, down the road, that will become important. As your business begins to grow, as your brand begins to grow, you're going to want to control what people see when they search your name. So you want to own your name.com as well as your business.com. These are early things you should do in businesses. I've seen a buddy of mine, for example, I'll give you a perfect example. A buddy of mine created a business and he had the domain, the signage, everything done, never went and bought the domain, told somebody else about it. They were kind of a competitor and they went and got his domain from him. So now he doesn't even have his company.com. It was available, but a competitor grabbed it because they heard him talking about it and grabbed it. That's what will happen in life. Now, I helped him go buy that competitor's name. the guy was like John Smith or whatever his name was. I helped them buy johnsmith.com to negotiate back. So now that guy, the competitor, owns their company name.com, and my buddy now owns that individual's name.com, so they can create some kind of swap. So this is why you want to keep both these things protected. It happens every day. So holding on these URLs means competitors or disgruntled customers can't have them, okay, which is really important to do. Okay, so you want to make sure that competitors, disgruntled customers can't have the actual domain. And I think I saw this on Shark Tank once, where I think Chris Sacca, I think one of the investors, had bought one of the other sharks' name or something to that effect. And they caught him by surprise. They didn't expect it. I actually saw this on a TV show as well, where somebody was really offended, but this is what somebody had done. I think it was during The Apprentice or something like that, where they went and bought their name.com. So this happens all the time, which is why you want to control these. So what if your business is Trust Therapist? Well, you can fix this if you change the business name to Trust Therapists with an S. Another issue is numbers. A company called Five Brothers Trucking should buy URLs with the numerical and also the number 5 written out. So for example, you're going to want, fivebrothers.trucking.com, the number 5 and the word 5 spelled out. So you can have both. Okay. So for a long number, you probably don't need to do this. 511brothers.com won't have 511brothers.com, right? But 511.com, brothers.trucking makes more sense than if you're just doing 5 brothers. You're going to want the number 5 and you're going to want the word 5 written out. So remember, you got to choose a business entity. You got to choose a business name with care, okay? Because if you don't, there's consequences. But again, if you do it right, there's a lot of benefits. You can even save money by choosing the right name and entity as well. So business names can trip you up if they're too generic. They don't say what you do. They're mashed up and incoherent. They're different words that don't go together, like Cheese Ninja put together. If you're deliberately misspelling names, trying to be creative, but then every time you say your website name, you have to spell it out. Advertising you're in a high-risk industry is also problematic, because that, again, can get you denied or get you red flagged with merchant accounts, bank accounts, the reporting agencies, all these different places you don't want to be red flagged. Creating disturbing or unintentionally amusing URLs is something to avoid too. It might sound funny to you, okay? But then again, it might not be funny to everybody else, okay? So for example, there's a lot of examples. You might, the bottom line is you don't want to choose something that's disturbing or unintentionally amusing, because it might be okay with you or funny to you, but not to somebody else. Okay, business entities make a difference in how you pay taxes. Are you taxed individually, or is the business taxed? It determines, and that makes a big deal. If you're choosing a C corporation as a startup, that's problematic, because all the profits on the business get taxed. Then you're paying yourself and you get taxed as well. So you get double taxed. So S corporations, it work really well in the beginning and then escalate to a C corporation. Even look at an LLC, even though it's not designated as a separate entity, but any of those over a sole proprietorship or a partnership will work well. And again, if you need any help with this is part of what we do with helping people set up their business and obtain credit financing. So we walked through actually 8. I threw in a bonus there, pitfalls to avoid when choosing your business entity and name. And as we talked about, these can cost you credibility. They can cost you customers. They can cost you loans and merchant accounts and bank accounts and all these things. Actually, there's not anything I've talked about today that I don't actually come to you from complete experience. I've had issues in these areas myself that lead to a lot of this, wanting to do this with you today. And also, I think it answers a lot of questions, because the choices you make of entity and business name are two of the earliest choices you make. And you want to make sure you go back and correct them or make them right from the beginning to set a baseline where it's easier for you to get merchant accounts. It's easier to get bank accounts and keep them. It's easier to get loans and credit lines and business credit. But it's also easier to attract customers. You're not creating unintentional barriers to get customers. And again, use me for an example, even CREDITSUITE.com, something I didn't talk about. Suite can be spelled multiple different ways. So when you're thinking of names, think about that. Are there even multiple ways to spell words in your name? These are things you have to think about, because if so, when you choose that name, like me, I now have to spell that out every single time that I say the domain. So things to think about as you're choosing the appropriate name and choosing the appropriate entity. So I'm going to go ahead and wrap this up. If you missed this will go on to YouTube, because it is YouTube Live. And always, anything we put onto YouTube or our main content through webinars or YouTube Live eventually does end up on our podcast as well. If you'd like to listen, you can find us on iTunes by searching my name, Ty Crandall, or searching the Business Credit Financing Show. Or to make it simple, just go to CreditSuite.com at the top right. You can access our social media channels where we have hundreds of videos on our YouTube channel. We have, I don't know, nearing 100 podcasts on our podcast. We also have go live on Periscope and Facebook every single week. We do a lot on Instagram. All of the links to our social channels are at CreditSuite.com. And again, if we can ever help you at all to get credit financing for your business, then let us know. 877-600-2487, 877-600-2487, info@CreditSuite.com. Thanks, everybody. Have a great day.